Good afternoon to you. Uh, Through the day earlier, we talked about three things. We talked about regulations, we talked about taxation, we talked about products, we talked about structures. How do we now put it together in a cohesive manner where it makes sense to our clients, it is of relevance to them, and they value it, and more willingly, they're ready to pay for it. Okay. So today's this particular panel is perhaps the most important for this group of people here. So let me start by saying, what does a value proposition mean in the world today, as far as global investing is concerned? And Arpita, I would like you to focus a little more on the HNI part of it.
Good morning. Happy and excited to be here. Before I start, Prem, before this, about an hour back, there was a 14th edition of a wealth management seminar. And the inaugural session focused on the key trends. And I think global portfolios and diversification occupied 50% of the bandwidth. Yeah. So it is really also reflecting the mind share. Investors as well, but more important, advisors and wealth management firms all over. From a proposition point of view, in terms of, I think all of us as investors, it's pretty intuitive to know and to think, currency, India will be importing capital, there will be a pressure, there will be a depreciation not as sharp as what we've seen in the recent past. Therefore, that's an effective hedge. And in the recent past, compared to, again, stating the obvious, 18 months or whatever, muted performance, in some markets, the performance has been stellar. More important, the themes that you don't get an access to, including deep tech and semiconductors and all, you don't have it here. So there is a very significant interest from the investors subject to the capital constraints that are there in terms of allocating capital overseas. It was interesting to hear, the panel before this on GIFT. In my 20 years so far, when I used to be at HSBC about 15, 20 years back, Hong Kong used to be the center of the world, the most vibrant capital market, I guess paralleling with New York and London, and then lost its sheen as it became more integrated with the mainland. I used to run an office in Singapore about 7 years back. It became a viable alternative. COVID took some of that. And then obviously in the recent past, Dubai has been extremely relevant. And so we have an office there. We have a licensed presence there. We just upgraded our license within the first year. And that represents the kind of interest that there is in HNI clients. So the familiarity with cross-border is a lot more now. The obvious ones, people have gone and most of the second generation has studied abroad. They hold assets overseas. The so-called home buyers, which dominated the conversations last decade, there's almost a FOMO of not being there overseas. It comes with its own set of challenges as well. So it is a secular allocation across all portfolios. For the smaller clients, there are platforms like a Crystal and a Stockel, and now even NSE is working on something on that. For larger clients, the presence that we have is in the form of an external asset manager, which is not one single product, which is diversified across all asset classes, across geographies. There's this huge interest, but there's a lot of friction in the way LRS accounts get opened. It's a great opportunity on paper, and while the numbers for LRS has come down largely in education, but one area where it's picked up is investments. So it's easily said than executed. Most global banks don't want to touch LRS lines. The paperwork is huge, compliance is huge, the ticket size doesn't sort of stack up, and therefore fund structure solutions available. So interest is real. I think the reasons are real. How you execute and intermediate that is very important. So for clients who are NRIs, much easier. LRS a little more tricky. And what ends up happening is, because of the limited pool available, instead of looking at it from a portfolio perspective, it goes and sits in a product. It'll be some long-only ETFs or it'll sit in some leveraged bond products. Both of them have their own challenges. So creating a diversified portfolio with at least 2 or 3 ideas with all of this is a big constraint. But it's a very, very vibrant field. We're spending a lot of our mind share on that.
So you say it is because of diversification and it is a necessity.
Yes.
You mentioned about the current. But from a CIO perspective, if I were to say, is a global allocation a tactical one or is it a necessary one?
No, I think from an allocation perspective, it's a no-brainer. It's not tactical, it's very strategic. Over 20 years, 25 years, home market bias and everything else, Indian markets have done very well, but we've been beaten handily down. Even if you roll back a year and go to Indian markets towards their all-time high, even at that point in time, we were beaten handily down by the performance of the US markets. US stocks have been the world's best performing asset class for a very long time. And now since then, our relative performance has actually worsened. So allocation globally is a tautology. It's a no-brainer. It's not tactical. In fact, even a 10-15%, which is our datum level today in terms of what is to be allocated overseas, that's a gross under-allocation. Ideally, it should be a lot higher. It should be probably 50-60% if it was possible. The bigger constraint is in terms of amount of investable money that is available, LRS, OPI. OPI is, of course, a lot better than LRS in terms of quantum available. The options in terms of structures that are there that you can invest in properly. So some of the friction that still exists in cross-border transactions. So those are the bigger issues. I think the broader concept of having a really significant allocation overseas is a tautology. It doesn't need to be litigated or thought through anymore. It should be done.
Okay. So, Ashwin, do you believe that a value proposition like this offers your clients to invest in something which is different, which is differentiated, and which is perhaps the basis for the rationale for any diversification? It has to be different. It has to be differentiated. Do you think there are opportunities outside which are differentiated from the ones available domestically?
So, Prem, thanks. In one word, yes. Okay, and as an institutional, platform, asset management platform, providing both inbound and outbound solutions. So, from an outbound standpoint, clearly we have to think, from segments of investors that we address. So, we have retail, we'll have HNIs, we'll have family offices, and corporates as well. So, you have, possibly non-individual investors taking the OPI route. So you have to really think from all that perspective. So yes, and today all sets of investors, who straddle across, these 4 segments, are curious. Okay, and a lot of these investment decisions as an asset managers that we install, are driven by a lot of queries that we get from these clients, right? So just to give you a number, in addition to what the previous panel spoke about, is the fact that in mutual funds you've hit the regulatory limit of 7 billion. But if you just look at the LRS numbers, 2019 about $400 million, cut to 2025, okay, 1.7 billion. So that's 4x growth. And if you look at the first 9 months of this financial year, you're already at 1.8, right?
And where I got mostly.
So this is obviously the investment component has increased.
Yeah. Okay.
Right. Earlier it was more education. It was more building a long-term corpus that Indian residents would want to build. I think the last few years we've seen a lot of money going to the US, going into stocks and ETFs. Okay, so the investment component overall has increased, and that is driven by the fact that you have certain themes that optically Indian investors may have missed out in the last 8-10 years. So you get let's say the CDMO story, pharma in India, but you have not participated in the patent ownership story that has existed. Likewise, development of certain themes, like you have OS, web installation, etc. But you are more in the generic part. So I think some of those themes have piqued the curiosity of investors a lot. So yeah, in one word, it does exist.
So, Arpita, are you leading the conversation or is the client initiating it? He says, in this case, the client is initiating it.
There is a lot of curiosity, yes.
Don't have to
Investors
be
are far
backward.
more aware now.
No, that's true. I think there was a time when you would talk to people. Here you, as I think Somnath also said, you don't have to make a case for it. The one reason is not only investments for Indians who want to own asset overseas. The pipe is going to be narrow. You can't take leverage. So anyone worth its salt at some point of time, if you want to have a corpus outside, with some currency diversification, there's a lot more interest. In fact, beyond LRS, what are the OPI is obviously you can't do it for investing only. There's some creative solutions, but we're not one of the firms that believes in that. And I think FEMA is something that one needs to be very, very careful of. But it's no longer a conversation where you start with saying, people start with this, with what is it that you can do for me? I want to create a portfolio. And there are genuinely certain product ideas that are available overseas, which you don't get. For example, very simple, regular product which most NRIs have an exposure to are these reverse convertible, structured notes. Essentially, if I like a HDFC at this price, if the price and I had a note which had that as an underlying, if the price corrected, I will need to cash settle it. There you could actually if I like Amazon at current price, I'm happier with it at 30% discount. As long as you're comfortable with the underlying credit there, or the genuine macro hedge strategies that are well. So I think it's especially for HNI, where the next gen has a lot more comfort, and the fact that they're very, very keen to have an asset outside, and this seems to be the only way. The conversations generally are actually, directed by clients themselves. You no longer have to make a case that global investing makes sense.
Okay. Arpita talked something which completely went over my head. So is it always rocket science like this, or is it something that we can... so what is it? Investing overseas sounds like...
Once more. Okay, after Somnath.
Somnath, according to me, is a guru. Okay? And definitely, I've known him for 25 years actually now. And anyway, so my point is it really very difficult to understand? Is it very exotic, very rocket science kind of stuff?
No, just to with your permission, actually what she said was reasonably simple. Indians do it all the time in the derivative side.
Okay.
On Indian
so
stocks.
My intelligence. No,
No, so I don't think the core of it is complex at all. It can be complex. There are things that are truly complex, but not everything is complex. Only at the maybe at the maximum complexity level could there be concerns around suitability, appropriateness. Otherwise, most of the stuff that we are talking about today are at ground level, which is 101 stuff. The more important thing is not so much product complexity. If anything, like on like, having an overseas long-only equities portfolio reduces risks on portfolios from 100% India allocation. So the bigger issue is not around risk and complexity. The bigger issue is on fairness, and fairness structurally. What is the fairness question? The richest 500 people in India have always had overseas assets and very significant overseas assets. It is only Johnnies like us who have traditionally not had overseas assets because we could not have overseas assets. So it's just systemically a question of fairness that there should be more access facilitated for the, I think these are wrong forums to talk of bottom of the pyramid because we are very far from there. But at least at the middle of the pyramid, at the top quartile of the pyramid, there should be structures created that facilitate access to overseas assets. Bulk of overseas assets will go towards reducing risk on portfolios. Bulk of overseas assets today, the ones that we are talking about, will actually make Indian investors more secure, not less. And hence, there is a quasi-social requirement to get this done and get this done efficiently. There are other macro-prudential considerations which are actually outside the scope of IFSCA itself, more in the realm of RBI.
Yes.
But I don't think product complexity is a problem with overseas assets. That's actually the last thing that...
Yeah, thanks, Somnath, for bailing me out. I'm going to take a minute.
Okay.
So, we did, I was reflecting on the larger family office kind of clients. What is it that they miss here and they have there? But from a client who is building a portfolio, I fully agree with Somnath. Actually, it's not tactical. It's a secular allocation. The products could be as simple as a India bond because of the rating. You get a far better exposure there. Mostly, I would have said a long-only idea as well, simple, straightforward, long-only ideas as well. But the crazy run that some of these markets have seen, it may make sense to have little more hedged portfolios. So what you do with that money is different. The need to take that money out is very secular, either currency diversification or an actual need to have an asset or fund your child's education or whatever it is. And the pool is going to be narrow. It doesn't look like it's opening up in the next foreseeable future. So in that sense, the requirement is simple, and you can stuff it up with the simple state strategies and you can do strategies which are not done here in India as well.
Okay. Ashwin, are we really talking about anything which is beyond US equities? Will it be confined largely to US equities? They could be in US ETFs, they could be in mutual funds, they could be direct stocks. Or will it be global alternatives? What will it be like?
No, I think, as I said, as the audience today, who interacts with all sorts of investors across segments, as I mentioned earlier. So yes, the first part, US, you see global investments into the US are massive. So us being a Japanese company, I can say that, even today, Japanese investors, besides India, Japanese investors, 70% of their allocations overseas, go to the US even now. Right, so that is a hub of investments. Looking beyond that, I think last 3 to 4 years we've seen China funds being launched in India by a very prominent asset manager. We are seeing value being created in the last couple of years in Eurozone, right? Some of the companies have done well, especially in the pharma side, right? So yes, there are pockets of opportunity, but I would go beyond that just to first ensure as an advisor to a client, so there's, the larger investors, UHN as a family office, but if I say people, the regular investor, first to ensure that they have that diversification, which is beyond, the India equity or the India equity story, right? So there, I think you need to look at, the broader indices. So, so if I was, as an investor, as a distributor, I was to start, I would recommend feeders possibly into, long-only ETFs as broad as S&P 500, right? And then look at possibly some funds who are active in long-only funds, and try and build portfolio, over a period of time. So yes, a lot of opportunities emerging, and it'll be a lot of information available. So it'll be incumbent on, the distributors to really do a lot of deep dive, because as Arpita rightly mentioned, there have been pockets of, a lot of euphoria that certain asset classes have seen in the last few years. Some have, tapered off in a very significant way. So investors need to understand that risk. Attached to what Somnath said, it has to be a strategic allocation and not tactical. So you write out some of those cycles.
Okay. And Somnath, if there were to be no restrictions on LRS and any caps on it, what would be the kind of allocation that you would recommend to a fairly high net worth client of yours? Would it be 5, 10, 15?
No. Actually, as I started by saying, I think that number should be well north of 50%. Well north of 50% of your portfolio.
Okay.
because there are just too many. India is a very unique market. India is in some ways a miniature version of the US in terms of a market that has multiple stories playing at the same time. But by no means India is sort of self-sufficient as an opportunity. There are tons of stuff outside. Deep tech does not exist in the Indian listed space. Commodities are very frugally represented in the Indian listed space, and even when they are, there are very serious governmental interventions in that space. Certain types of manufacturing entities, semiconductors, etc., do not exist in the Indian listed space. Data centers don't exist yet in the Indian listed space. So I think the opportunity pool for investing is rather larger than India. And just look at it from a pure analytical perspective. India accounts for maybe 2% or little less than 2% of MSCI World. That's the global equities index. That's the bellwether index for global equities. India accounts for 2% of MSCI World. Now, we live in India, we eat, drink, whatever in India. We know India the best. We know what's happening to HDFC Bank a lot more than we know what's happening to Bank of America. That's the fact. And so there will be a home market bias towards an oversized allocation to India. But that oversize can go from 2 to 20, 30, 40. If there were no limits, that number for overseas allocation will be well north of half.
Okay. What would your response be, Arpita, if there were to be no limits? Let's assume. How much would your wealth management firm recommend to your clients, your high net worth clients? I'm assuming.
Sure. No, philosophically, I don't have any quarrel with what Somnath is saying. A large allocation would make sense if there were no capital controls. But the clients that you deal with, or the clients that I'm most comfortable talking to, are ones who understand what they're getting into, because a lot more familiar you are, the better you understand your worst case scenario, the more steady hand it will be at investing. Otherwise, the usual pressures of investing or pulling out money when the market is worst and trying to get in when euphoria is high. Simply because of that lens, because in any case, capital markets brings with itself its round of volatility. Add to that mix the geographical spread, add to that mix currency, the familiarity is very, very low. And therefore, I think there's some journey to be traversed before people get comfortable with what they're getting into. Simply for that reason, I think it would be a lot more calibrated for us. Obviously, the clients at the top end who've had an exposure in the past, who understand what they're getting into, I think a large allocation or an equal allocation are a problem. But for smaller clients, I think their familiarity is low, which is going to make them very, very anxious. There's a journey to be covered. So that I don't think it'll go beyond 15-20% at all.
Yeah, just to add just half a 10 seconds, completely agree. And we went through that journey for mutual funds. When I started working, mutual funds were 1% of total savings pool. Today, mutual funds are a lot more significant, 6-7% of total savings pool. So it's taken a 24-25 year journey to get there. So that will have to be done. What I was referring to more as a steady state at an analytical level.
Yeah, absolutely. I got that. Ashwin, you, when we were talking a little earlier in the day, you mentioned something about you would be launching a product which would feed into a UCITS fund, right? Now, tell me, why didn't you think of a gift city structure? Because
no, Prem, this is a gift city structure.
This is a gift city structure.
Feeding into a fund, a master fund in Lux jurisdiction, which basically is investing in some of the AI companies and its adjacencies.
Okay.
It's a gift.
But what if it were not to be listed or registered with Gift City? What would be the tax implications? How would it affect your investors?
No, from a tax standpoint, Prem, the difference is not very large. If I may add here, I think it is the DTAA, the TT countries Okay, and as the previous panel mentioned, okay, for in most of these countries, okay, the cap gains are exempt. Okay, but in India, if you stream back the capital gains before 2 years, they're taxed at MMR. Okay, after 2 years, okay, they are taxed at the long-term capital gain of 12.5%. Yes, the complexity is slightly more if you were to invest directly into stocks. Okay, that is when the filing, etc. Okay, that can consume time and bandwidth, and of course more understanding, and the dividends. Okay, which downstreamed are taxed. Okay, but just want to add here that even from a dividend standpoint, there are ETFs. Okay, schemes which are reinvest the dividends immediately, and eventually you they reflect in the NAV.
Got it.
So the tax incidents can be deferred.
Deferred, correct. And Arpita, between again relatively simple products to alternates to from ETFs to mutual funds to direct stocks to more exotic alternate products, what do you normally go for when you're dealing with your high net worth clients?
That largely would depend, Prem, on the sophistication of the clients. It's the first experience. It's got to be extremely simple.
Okay.
Because there is already a asset class and a geography and a currency risk that most people may not be comfortable with. So it would be at this point of time or the last some few months, not a big fan of completely unhedged equity ideas. But someone who's looking at it from a 3-5 years perspective, simple, straightforward, most inexpensive liquid ETFs, a good idea across geographies. For Indian clients who are not who are largely worried about having some amount of capital preservation, some of the, at least the names that, for all Indian names, there are overseas issuers, similar rating, so sophistication of the client. But
That's Somnath. I have one a very simple question for you. There's a plethora of choices. It's genuinely a whole new world outside. How do you research? I mean, whether it was to talk about individual stocks or ETFs or mutual funds, there's so many. I am not even getting into geographies. So how do you research this thing? Because this audience here doesn't necessarily represent companies' wealth management. Many of them work on their own. So how do you research, and what would your advice be to them?
Right. So you have to, whoever is offering this needs to deploy enough resources. It requires in fact, more resources than it does to evaluate, diligence, originate, put together products, portfolios together. The ocean is considerably larger than the Indian Ocean.
Yeah.
So you need to deploy enough resources to the job. The good news is that fundamental basics of evaluation don't change. The core knowledge, which is investing knowledge, can be distilled, according to me at least, into essentially two skill sets. One in maths, the other in psychology. So whether you are evaluating HDFC Bank or Bank of America, whether you are evaluating Nippon's mutual fund or BlackRock's global fund, the basic concept skill set that you require are maths and psychology. They don't change. And now with artificial intelligence and a variety of tools that are available at our disposal, the ability to evaluate and evaluate at both scale and speed has just gone up. But there is absolutely no doubt that it requires deployment of resources to the job, and it is not something to be done on the fly with shortcuts. No, that's not an option.
But how could they start? What would be the first baby steps that they could take?
In terms of investing?
In terms of evaluating, exploring opportunities which they could recommend to take.
Right. The first thing to do would be to just pick up ACWI, which is the MSCI Global Equities Index. That is the first stop, port of call. The other first port of call is just pick up S&P 500 as a marker and start with that, because US is about 60-65% of global market cap. ACWI is the entire 100% of global market cap. So between the two forms the very core of any baby step, the first steps towards investing globally.
Good. Arpita, I wanted to ask you, does global investing increase wallet share and client stickiness?
Yes, yes, of course. There are a few. So as I think Somnath mentioned, there is a certain amount of understanding, resource commitment that you need to have before you take a idea to a client. And while it's a trend that's catching on, not every firm is at a different stage in their journey. For us, amongst the first port of call was, for example, GIFC Cat 4, which is a 3C, and we used to have okay, for us, the first port of call here was to set up a DIFC office in Dubai, which is upgraded to a 3C office.
Okay.
So depending on the regulatory presence and the resource commitment that you have, your ability to take to clients is very high. Not every firm is equipped or resourced to do that. So if you're able to handle that, definitely the wallet share will go up. And the complexity can be overwhelming for people who are doing it on their individual basis. Complexity is overwhelming not only in terms of products, but also in terms of friction that is there in having a seamless account opening and getting you to an idea. What then happens is the first biggest mistake, because the pool is small. You can't create a diversified pool of ideas. You will do a product-based first allocation. If that experience is negative, that's going to be a challenge. So from people in the room here, it 100% increases your stickiness and share of wallet. But giving it some time and understanding it and aligning with a firm, there are a lot of now DIY platforms. I think it is fantastic, but it's for people who understand what they're getting into. As an advisor, you need to spend some time understanding that, getting that right. There are asset allocation fund frameworks that are available. You put in 1 rupee, it at least goes into 3 or 4 different strategies. Okay. The big mistake would be with a sense of fear of missing out, getting into something which is already has a fair amount of euphoria, and that being your first investment idea. The client who's never handled before is going to, the accountability will be yours. So I would be...
Totally. As far as these overseas assets are concerned, what is your business model? Do you charge them a fixed fee? Do you take commissions from product manufacturers? How does it work at ASK?
So from our perspective, we've actually gone the asset management route. We have wrapped all our overseas solutions. Now we've set up platform in Mauritius, which is our oldest platform. We've got a setup in DIFC, which is our newest platform, and we have a GIFT City presence. So we have 3 sort of pockets where we offer overseas solutions. Bulk of the solutions are multi-asset, multi-strategy solutions, but wrapped in fund formats. So either it's a Mauritius fund or it's a GIFT City fund. So that makes it a lot more seamless, frictionless, and a lot easier for lower tickets to participate.
So you don't recommend products outside these 3 structures?
Rarely.
Would you recommend an ETF, for example, if it wasn't a part of these 3?
No. So if we liked an ETF, it would evidently and invariably make its way into one of the fund strategies that we are offering. Most of our strategies are fund-of-fund strategies, so that it will make its way into one of the funds. So we do offer other stuff as well, which is outside of the fund vehicles we have created. But generally, as Arpita said, friction there is higher. You have to open platforms and stuff like that, so it's rare. Mostly we do it via the asset management route, and I must say that Pawan was here in the previous session. GIFT City, for an Indian investor whose primary use case is investment and diversification of portfolios and not to take capital out of the country. because GIFT City is not a vehicle for taking capital out of the country. Capital very much remains in India. It's an hour's plane ride away in Ahmedabad. Capital is pretty much here. It's just that your exposure can be global. As long as the use case is diversification and access to global opportunities, GIFT City has done a fabulous job. IFSC has done a fabulous job in terms of facilitating that. The platform there is extremely good in terms of friction, extremely good in terms of taxes, and the regulator is one of the most supportive regulators that I have at least interacted with.
And Arpita, what is your business model as far as overseas investing is concerned?
Okay.
What is the source of revenue? And I'm curious to know what percentage would be as a part of your overall revenues.
So actually, it's a fairly, the Dubai office is the most recent one, and for reasons Somnath mentioned, GIFT City is on the radar.
Yeah.
The one important distinction, as he pointed out, that it is not externalized. It has to come back, but it's great from a portfolio diversification point of view. I'll underline the Dubai strategy with a little bit of it is for a certain, largely for the NRI clients that we have. LRS is done through an asset allocation. So in Dubai, the license is what's called an external asset manager license. So you're not confined to, products of a single bank. You work with various banks and custodial arrangements. It's a completely open architecture approach. You are fed, and therefore in that sense also there's a resource commitment, but there's also secondary ideas and research that keeps coming from the top 10 commercial banks. You create something that works for your client, but it is not tied to one manufacturer. It's an open architecture. The closest proxy of that is a multifamily office in here. So it's an external asset manager approach there. The AUMs are building out fast. The revenue usually tails that, but I think we reach 100 million in a few months.
Okay. We have about 3 minutes left, so let us make it worthwhile for this audience. One piece of advice for advisors starting global investing. And let me begin with you, Ashwin.
I think going forward, I think outbound, will become a very important dimension of advisory to prospective investors. I think over the next 3 to 4 years, this is going to be extremely popular. I think the logistical challenges, etc., notwithstanding, I think as Somnath mentioned, GIFT is trying to iron that out. And this is something that we've seen because we also straddle across various jurisdictions. We have an AMC in Singapore, we are in Japan for obvious reasons, we're in Mauritius, we're in Dubai.
And we are talking about Nippon India. We're not talking about Nippon global.
Nippon India. Yeah. I'm talking about Nippon India, yes. Right. So from from distribution advisory standpoint, I think riding on, the obvious lack of global diversification in Indian investors' portfolios, I think next few years are very, very exciting. My only note of caution here is that, since, you will look at multiple geographies, you look at multiple products, okay, you need to familiarize yourself, okay, with at least platforms that offer, some of these solutions. Okay, so both from a standpoint of us as an asset manager, as an institutional platform which is offering multiple products like these two here. So I think choosing the right partner that you route these investments through is equally important than familiarizing yourself with those, with the investment. So very exciting times.
And the products which are registered with GIFT City, can domestic investors recommend those products to their clients?
Absolutely, they can. Yes. See, there are nuances of, where these GIFT City, products, obviously you have the vehicle there. Okay, now where are these registered? Okay, because there are nuances, complications in terms of, how you can solicit investments from even NRIs. So it will vary from jurisdiction to jurisdiction. Okay, Singapore, and obviously the popular countries are, Middle East, Singapore. Okay, in recent times, Australia has become very, very large. Japan, in the last 2 years, we've seen almost more than $20 billion that has come in to India. So both inbound, outbound, okay, is critical. So I think you will be able to, for both inbound and outbound, investments, you can easily get onboarded. It's a 10-minute process, with an AMC in gift. Okay, and then you can start selling these products.
Okay. Arpita, one final piece of advice for distributors who are looking at global investing.
Sure. So, two kind of customers. If your clients are savvy and NRIs, simpler, but if it is largely India LRS clients, I think a diversified portfolio with that amount of money that's also going out is very important. So, index and ETFs definitely better than single stocks. ETFs with different strategies across different geographies much better than a single allocation there. Most of the clients want to start out with wanting to experience the currency part of it without taking too much of risk. So some amount of understanding of that market is important. If the first experience is not okay, it's going to be difficult. Therefore, as Ashwin said, choosing the right partner is difficult. Currency, geography, and different asset classes, it's mind-boggling amount of complexity. What should not happen is a 3 or 5, Mag 5 doing really well, and through a platform which is DIY, you sit in there, you're doing a disservice to the client. So as diversified as you can get with the right partner.
Okay. So not one final piece of advice for distributors who are looking at global investing.
Yeah, I'll keep it short. My point will be start now. Don't wait.
Okay. So thanks. On that particular note, so it was a great. It was great having Somnath, great having you, Arpita, great having you, Ashwin. Thanks for sharing your insights with this audience.
Absolutely.